Natalie, Harms reporter for CoStar News Hotels, and I'm here at the Hunter Conference in Atlanta with Ryan Bosch, principal at Arriba Capital. Ryan, thanks so much for taking a break from the conference to chat with me.
Yeah, thanks for having me.
So I think everyone agreed that this year was going to be better for hotel transactions than last year.
Absolutely.
We're almost a quarter of the way into the year. Have things in fact improved?
Yeah, we've seen a meaningful pickup on transaction activity so far. I mean, I don't think it's, for projections last year, everyone was kind of hoping a 30-40% increase this year. I don't know if we've hit those numbers at this point in the year, or on pace to hit those numbers, but yeah, we're seeing a lot of acquisition activity. I'd say at least double from what we saw in Q1 last year, at least in the middle market.
Okay, so what are the deals that are happening? You know, what types of...
Yeah, I think, I don't want to say distress, but I think there's sellers that have pressure on them from multiple angles, whether that's executing a new PIP, whether it's a maturity refinance, that we're kind of hanging on the last couple of years and didn't want to sell, didn't want to transact, but I think the pressure's mounted where we're seeing that. The other side is, the REITs with net asset value issues. We're starting to see a lot more dispositions from them, and those assets kind of trickle down with middle market buyers acquiring them.
Okay, so what deals are getting funded and who's funding them?
Yeah, I mean, I think there's the debt markets are flush right now. There's capital availability from all angles. So we're seeing meaningful activity on the CMBS markets. We're seeing banks coming back in a pretty big way, especially in the last 60 days. I think there's more capital chasing deals than there are deals chasing capital in the market, so it's a good time to be on the borrower side.
Okay, gotcha. Yeah, are there any specific types of hotels that are seeming more attractive to buyers?
I think there's different opportunities in different markets. Extended stay is extremely popular right now. On the full service side, we're seeing more of a preference for lifestyle type assets. I think of higher ADR ceilings. And then generally select service, limited service. So when I say that, the big box, full service Marriott's, DoubleTrees, I think there's less capital chasing those deals right now.
Mm-hmm. Are there certain markets that are seeing more activities than others?
Definitely. I think Sunbelt in general, Texas is extremely active, Florida is extremely active. We're seeing drive-to leisure destinations, a lot of activity. And then I think we're seeing some markets where we're having basis resets in pricing and valuations. So like Bay Area is a good example, where meaningful uptick in transaction activity. But I'll say this, I think there's macro headwinds in a lot of markets, but even in some of the more distressed markets, there's still submarkets there that are being resilient. We're seeing RevPAR growth on more of a micro level. So very market to market dependent, but I think nationwide we're seeing pockets emerge all over the place where acquisition activity is picking up.
Mm-hmm. Yeah, I think we talked about the difference between last year and this year so far. We knew we had some macroeconomic trends kind of continuing from last year into this year. We also have some new ones. So what are kind of the biggest macroeconomic factors, the biggest headwinds that you're considering?
I think it's the pressure on the Fed and interest rates is what people on my side are watching most closely right now. We were expecting more interest rate relief this year. I think with the whole Iran conflict, as of recent, there's going to be more pressure to keep rates elevated most likely in the interim, but that could change very quickly, depending on how things play out. But I think interest rates are having the biggest effect. If you look at long-term treasury yields right now, which is the major driver on permanent financing, market expects those rates to go up over the next 10 years, not down. On the short-term side, for construction loans, bridge loans, floating rate debt, I think we'll get some rate relief throughout the year.
Yeah, I know, I think a year ago we were really talking a lot about the bid-ask spread being so wide. I think some things changed later in the year, but what does that look like these days?
I think there's no question that it's narrowing, and I think what's helping drive that more than anything is we are seeing acquisition activity pick up, and I think one of the issues on bid-ask spread was price discovery in a lot of these markets, where there hasn't been much acquisition activity. So I think as we start seeing kind of this first wave of trades happen, price discovery really capitulate in these markets, we're going to see transaction volume pick up based on that.
Mm-hmm. Yeah, and I guess, I don't know how much new builds versus renovations and repositionings, how much that's kind of affecting deals.
no doubt, I think making a ground-up development pencil today is extremely challenging. There's still deals that make sense out there, but we're seeing much more activity on the conversion side. The ground-up activity that we're seeing, for the most part, we're seeing more, office conversion plays than pure ground-up development, where maybe there's city tax incentives, tax abatements, historic tax credits. There's got to be a different driver that's kind of driving the basis down on these ground-up developments to make it make sense today.
Yeah, that's interesting, the office redevelopment side of things. So I'm interested in your perspective. I know the World Cup as a performance-related topic is obviously top of mind for a lot of people, but I'm curious, from the transaction side, how do you think of the World Cup and how it's going to affect the industry as a whole?
I think from what we're hearing from our clients in those markets, no one's seeing the lift that they expected or anticipated so far on pre-sales. But that being said, I think we're still going to see meaningful uplift in those markets. How that affects, valuation, financing activity, I think it's going to help, but I think most sophisticated underwriters or buyers are going to kind of underwrite that in as a one-off event, and that revenue is not going to be sticky. So I think it's good for the industry. Hopefully we see sales pick up in those markets from what we've seen so far, but I think it's going to be pretty short-lived.
Yeah, that makes sense. Well, let's pretend you have a crystal ball. What are your expectations for the rest of this year?
I think that's a good question. Expectations for the rest of the year, transaction volume is going to pick up. I don't know if we hit that 30-40% threshold. I think maybe 20-25% is what I'm expecting. But I'll say, I think it's a great time to be a buyer today. I think there's a lot of capital out there on the debt side. Equity's more challenging, but I think if you have the equity figured out, there's going to be some really good basis plays throughout 2026.
All right, well, I guess we got to stay tuned to see what comes to fruition. Ryan, thank you so much for taking the time. It was a pleasure.
Thanks for having me.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of the CoStar News Hotels podcast was recorded on March 17th, 2026 by Meredith Sheridan at the 2026 Hunter Conference and was edited for the podcast by me, Natalie Harms. Find all hotel industry news at costar.com/hotelnews. Thanks for listening.